AI is moving fast. Some businesses could be disrupted by it, but some businesses will benefit from it. And as investors, that's the only question that matters. So we went looking for companies that don't just use AI, but could actually become more valuable because of it. What we found was interesting. These are 6 Indian companies with strong business models, growing earnings, and one thing in common. The more AI gets adopted, the stronger their position could become. And these aren't AI hype stocks. Most investors already know the obvious names. This list is different. In fact, the last 2 stocks on this list may be the most interesting opportunities of all. Hi, I'm Aparna and today we'll be covering each of these 6 stocks one by one. What do they do? How are the numbers looking for them? What could go right? And most importantly, what could go wrong? So stay tuned till the end. Stock number 1 is IKS or Inventurus Knowledge Solutions. Everyone's saying AI will wipe out healthcare back office jobs. But what if AI actually makes one company more valuable? That's the story with IKS. Let's understand what they do. UK hospitals handle hundreds of important tasks every day, like maintaining patient records, managing insurance claims, medical documentation, and billing. If these processes aren't handled properly, hospitals can lose money or face regulatory issues. IKS handles all of that. Basically, they are building a technology-led healthcare operations platform where AI doesn't replace the business, it supercharges it. The opportunity here is massive. IKS estimates its addressable market at $260 billion. But here's the thing, only $35 billion of that is currently outsourced. And that outsourced segment is growing at 12% annually. IKS is growing faster than that, which means one thing, they are taking market share. Now here's what makes them interesting. Most healthcare technology vendors solve one problem. IKS is building the layer that connects everything. 16 healthcare workflows, one integrated platform. And the numbers are starting to reflect this. Q4 FY26 revenue grew 18.5% year-on-year to 8,577 crore. EBITDA grew 33%. But this number really caught my attention. While revenue grew around 19%, employee headcount grew only about 5%. Think about that. Traditionally, outsourcing companies needed to hire more people to earn more revenue. IKS is breaking that relationship. Revenue is growing 4 times faster than headcount. That's AI and automation improving productivity in real time. Through acquisitions like TrueBridge and ARAI, IKS is strengthening its position in healthcare AI by gaining access to millions of patient records and building AI systems that are transparent and reliable. Management believes this combination of data and trusted AI could become a big thing over time. The stock trades at around 1700 rupees, roughly 40 times earnings, compared to an industry average of about 24 times. The premium here is real. The risks are real too. Execution is the biggest one. Integrating TrueBridge is complex, hospitals are slow at adopting new platforms, and AI-driven pricing pressure could squeeze margins in certain workflows. Now let's move on to stock number 2, Indegene. Now let me paint a picture here. A pharma company spends 10 years and billions of dollars discovering a drug, getting FDA approval, navigating regulations across 50 countries, training thousands of doctors on the drug, monitoring side effects globally, running marketing campaigns, managing commercial operations. That entire journey after discovery, that's where Indegene lives. The company helps all top 20 global pharma companies with medical affairs, regulatory submissions, pharmacovigilance, omni-channel marketing, analytics, and commercial operations. Now here's why AI helps them. Most IT companies earn money by selling manpower. So if AI reduces the need for people, it can impact their business. Indegene is different. It works on critical pharma functions where medical expertise is still essential. AI enhances this but does not replace it. The market opportunity here too is very huge. The global pharma industry is expected to cross $2 trillion by 2030. Outsourced life sciences spending is projected to nearly double to close to $100 billion by 2030. And the growth story is already playing out. Over the last 5 years, Indegene has grown revenue at nearly 30% annually. FY26 revenue crossed 3,500 crore with EBITDA margins close to 20%. But here's a number that tells you clients actually trust them. Active client relationships have doubled from 44 to 91. Clients spending more than $1 million annually jumped from 22 to 53. Revenue from their top 20 clients has tripled. The stock is trading around 523 rupees at around 30 times earnings, actually below the industry average of 39 times. But the risk here is simple. If pharma companies take longer to consolidate vendors, Indegene's growth may not be as fast as expected. Now let's move on to stock number 3, Sagility. US health insurers are in serious trouble right now. Medical costs are rising, regulatory pressure is increasing, profitability is getting squeezed from every direction. Their solution is don't hire more people, instead automate operations and find partners who can do more with less. That's exactly where Sagility comes in. It works with leading US health insurers. They handle claims processing, member management, care outcomes, enrollments, and administrative cost reduction. About 90% of revenue comes from healthcare players, making it one of the purest listed plays on US healthcare outsourcing. The shift happening inside is worth paying attention. The company has already deployed 37 AI use cases. They work with 80 plus healthcare clients and they are winning transformation-led deals rather than traditional manpower contracts. The numbers show this is working. FY26 revenue grew 29% to 71,930 crore. Adjusted PAT jumped around 40% to 11,310 crore. 17 new clients added during the year, around $130 million in annual contract value wins signed across FY26. Now at around 40 rupees per share, Sagility trades at about 20 times earnings, which is below the industry average of 24 times. But the risk here is AI itself. As automation becomes more effective, AI starts reducing the billable work. Management has already flagged that AI-led revenue reduction is expected to rise from the historical 1 to 1.5% range to above 2% in FY27. Now let's move on to the next stock, which is RateGain. But first I have a question for you. Every time you search for a hotel on Google or check prices on booking.com or make a booking, do you know which company is likely operating in the background? It is RateGain. RateGain is building the operating system for global travel demand. The company serves 33 of the world's top 40 hotel chains, all leading online travel agencies, 4 of the top 5 airlines, major cruise lines, and destination marketing organizations. And after integrating Sojourn, they have built what they call the world's largest travel intent data platform. FY26 was a transformational year for them. Revenue jumped nearly 70% to 1,820 crore. Adjusted EBITDA grew 54% to 360 crore. Q4 alone delivered 716 crore in revenue at nearly 23% EBITDA margin. But the real story is the shift from software to AI-driven revenue outcomes. RateGain's newer products don't just improve productivity, they directly improve revenue for their clients. Management has guided FY27 revenue around 3,100 crore with EBITDA of around 650 crore. The longer term ambition is a $1 billion revenue travel intelligence platform. The stock is around 750 rupees, trading at 40 times earnings, which is premium to the industry average of 30 times. The risk here is data moat erosion. If Google, Booking Holdings, Expedia or AI-powered search engines start keeping more traveler data inside their own ecosystems, the uniqueness of RateGain's data advantage could narrow. And since many of their AI products are built on that data advantage, that's a real risk to monitor. So the 4 companies we just covered are all vertical AI plays which are deeply embedded in specific industries. Now let me show you the 2 broader IT companies building AI capabilities across multiple sectors. These basically are the horizontal plays. The first stock is Coforge. The company helps banks, insurers, airlines, and healthcare businesses upgrade old technology systems. What's interesting is that management is gradually moving away from the traditional IT model of charging for manpower. Instead, they are trying to charge clients based on the outcomes delivered. In an AI-driven world, that's really important because your revenue is tied to value created, not headcount. And the numbers suggest it's working. Healthcare vertical grew nearly 100% last year, travel grew over 60%, 21 large deals were signed, order book hit a record $1.75 billion, which is strong visibility into future growth. Another major growth driver is the Encora acquisition. It takes the combined revenue base to nearly $2.5 billion and strengthens presence in North America. The stock is around 1,400 at roughly 37 times earnings, which is a clear premium versus mid-cap IT peers. The risk here is concentration. About 45% of revenue comes from travel and BFSI. If airlines slow tech spending or banks postpone transformation programs, growth could slow faster than expected. Now the last stock on the list is Persistent Systems. Imagine a bank running on 20-year-old software, an insurance company stuck on systems from the 1980s. Persistent comes in, modernizes the infrastructure, organizes the data, and then layers AI on top. That's the business. And here's why it's structurally in a strong position. AI cannot work on messy data. Before any enterprise can deploy AI agents, they need cloud migration, data governance, security, compliance frameworks, and workflow redesign. Persistent sits exactly at that bottleneck. Every company that wants to go AI first has to go through this journey first. Management has built 3 internal AI platforms: Sasva for software engineering productivity, GenAI Hub for business workflows, and iAura for enterprise data modernization. They hold 120 plus AI related patents and 7,000 plus AI certifications. Partnerships across Microsoft, AWS, Google, Salesforce, Databricks, and Nvidia. The financials are strong too. Revenue crossed $1.65 billion in FY26, growing 17.4% year on year. EBIT grew 31.5% and PAT grew 33.2%. That operating leverage is exactly what you want to see. FY26 closed with $2.4 billion in bookings. Client spending $5 million plus annually grew from 55 to 62. And management is targeting a $2 billion annualized revenue run rate by FY27 exit. The stock is around 5,000 rupees, trading at 41 times earnings. The market is clearly pricing in sustained high growth. The risk here is the productivity paradox. If AI makes software development much faster, companies may need fewer engineers. Persistent will need to keep offering higher value services so that AI doesn't reduce the demand for its work. So let's bring it all together. 6 companies, all positioned very differently, but all benefiting from the same mega trend. Now I want to hear from you. Do you already own any of these companies, or is there a name you think should have made this list and we missed out? Drop it in the comments. We read every single one of them. If this video helped you, like it, share it, and subscribe to the channel if you haven't already. It genuinely helps us grow. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.